This episode is made possible by NetSuite by Oracle and Brex, the AI-powered spend platform.
Hello, this is Jim Cassie, CFO of AvePoint, and you are listening to the CFO Thought Leader Podcast.
This is episode 976.
I want to make sure that I think ahead from a systems and a process and kind of a people and skills to what the future looks like. And I'm very much about avoiding the drama and the fire drills to the extent you can. So, kind of thinking ahead and doing the things you can in a more measured way than kind of waiting for to be forced into doing things. So that's one. Kind of developing my team, helping them be successful, helping them see value and connection with the company and what's going on and all the change, and just helping them to stay engaged and successful is really important for me. And of course, it's an ongoing thing, growth versus profitability, and making sure that we're running a good business and that we're delivering good results and making the right investments for the future.
Hi, it's Jack. On today's episode, we speak with Craig Wert, CFO of Jobber. Lessons from Craig Wert's finance career reveal the power of adaptability, problem-solving skills, and the ability to seize opportunity in unexpected places. Having started his career without a clear roadmap to the future, Wert had a career that might have led in any number of directions. However, what began to set him apart was an innate ability to troubleshoot. Throughout his career, he was frequently called upon to solve complex problems, whether they be operational or financial crises due to the economy. Every challenge he overcame was a stepping stone to new opportunities. Or so Craig Wert reveals to us on today's episode. We'll begin after this. 37,025-1. These are the three numbers to remember to get the visibility and control you need to make the right business decisions instantly. 37,000. That's the number of businesses which have upgraded to NetSuite by Oracle. NetSuite is the #1 cloud financial system, streamlining accounting, financial management, inventory, HR, and more. 25. NetSuite turns 25 this year. That's 25 years of helping businesses do more with less, close their books in days, not weeks, and drive down expenses. 1. Because your business is one of a kind, you should get a customized solution for all of your KPIs in one efficient system and with one source of truth. Manage risk, get reliable forecasts, and improve margins. Everything you need, all in one place. Right now, download NetSuite's popular KPI checklist designed to give you consistently excellent performance, absolutely free, at netsuite.com/KPI. That's netsuite.com/KPI. Hello, we're speaking to Craig Wert, CFO of Jobber. Craig, welcome.
Thank you, Jack. Nice to meet you.
Yeah, good to meet you, Craig. We always begin by asking the guests to look back for us. And what we're looking for are those experiences that now, as you look back, you realize they had an important role in shaping you as a finance leader. Anything come to mind for you?
Yeah, I mean, maybe I would start by saying that I didn't plan to be a CFO. I didn't have, kind of a roadmap mapped out. And maybe as I look back now, I did plan on doing this work for this kind of company, but it could have been in many other roles. And when I had a bunch of different types of roles along the way here. And sort of maybe going back to the beginning, or mostly to the beginning, when I was in college, I was a liberal arts major. I studied history and government and economics and kind of nothing pre-professional. And I wasn't, kind of trained to be an accountant, which would have been nice to get a job back then, or I didn't have a plan to go to law school. And so what I ended up finding when I came into, kind of looking for a job was an opportunity with an investment bank. I joined this firm, Alex Brown and Sons, which is part of a bigger firm today, but at the time it was an independent in an investment bank that focused on growth companies. While I was there, we took Starbucks public. We've been part of Microsoft and just a lot of different growth companies, tech, healthcare, and consumer and other industries. And this opportunity I had was in one of their investment banking training programs, which they did all the banks did back then. I think many of them probably still do, where they would hire, kind of smart, motivated people out of undergrad and train them. I didn't know how to use Excel. I didn't know how to build a model. I didn't know anything about really business other than reading the papers. And, I didn't know how to build a presentation or spiral bound a pitch book, or, there's some of it's grunt work, obviously, but they trained you. And that was what was appealing to me. And it was a chance to just see the world of finance. They would invest in training you. What I liked about the experience in Alex. Brown was seeing lots of different companies and industries and just kind of being a sponge and learning. And it was a structured program for 3 years. And at the end of that, the analysts in the program I was in, they either back then, and today it may have changed a bit, but back then you either went to business school or you went to some other kind of job or somewhere else in finance. But you usually left, that firm, and they would hire new analysts and kind of, do the same process. And so for me, what ended up happening was I didn't end up getting into the business school. I only applied to one school, and I didn't get into the school at the time, and which was fine. But I then needed a plan B, which turned out to be a pretty awesome plan B. I joined a private equity firm called InvestCorp, which was a buyout firm, but a private equity in New York. So all of this was in New York back in the 90s. And when I joined InvestCorp, the firm was so what I was looking for is I started kind of on the banking side, working with clients, helping to facilitate transactions, between clients and investors. But when the deal was done, you moved on to the next deal, the next client. And I felt like I wanted to be more, kind of in the game, more a doer, part of creating the value and building a business. And what InvestCorp offered me the opportunity was to get closer to that, to be what we used to call principal, to be, the investor. So a lot of the work was the same, building the model, doing the capital structure, but some of it was different, and the relative importance was very different. So, for instance, due diligence at an investment bank, where you go to a client, you kind of make sure they're legit and they have a real business and their financials look right, but it's not your money at work, ultimately. So the level of rigor, and you don't want to grill the client and put them through a lot of rigor because you want them to like you and hire you and work with you. So it's sort of a lightweight, in my experience, level of diligence. Whereas when you're on the private equity side, it's much more rigorous because you're going to own this. And if you get it wrong, it's going to be on you, and your clients whose money you've raised to finance this are not going to be happy. So the nature and type of diligence is dramatically different. So that was one thing I learned. And then, of course, which was what I was after, is I spent time with the portfolio companies once we bought them, helping to manage them. So in my portfolio that I was assigned to, I had Carvel, the ice cream chain. I had Saks Fifth Avenue, a major retailer. I had Star Markets, a supermarket chain up in the Boston area that we owned at the time. And while I was there, we bought a company called Simmons, the beauty rest manufacturer. And we looked at lots of others, fast food chains and chemical companies and plant growers. I was big into, I really liked gardening, and I was super excited about this company we never bought, which grew plants for Home Depot and Lowe's, which I've kind of fell in love with the business probably more than the investment opportunity of it. So, but anyway, I was young and learning, but it was a great experience, and it really showed me a lot. And then, so that to me is kind of stage one of my my career development, was the early finance exposure and basic skills, if you will, and how to think about the world, how to value things, how to kind of do comps, and just how to break apart the numbers and understand them, and all of that. So, from that perspective, that's great training to be a CFO. But then what happened is I went to business school. And this is in the late 90s, and it's the dot-com, period, and everything is, super, and tech is the place to be. Like, that's what's going on. And as I said, I was kind of trying to move closer and closer to being part of, like, actually on the field building a business. And so coming out of business school, I came across an opportunity to join this company, RCN, which was based, I live here in New Jersey, and it's where right very near was where they were based. So I moved here after business school and joined RCN, and they, kind of sold me on, a GE training, the leadership development program that they use the words like the example of GE, but this was a startup. They were nowhere near the execution of a GE kind of program. But the storyline sounded good. The reality was much more self-managed and very unstructured, unplanned. But
Yeah.
but I spent 7 years at RCN, and it was kind of a boom and bust cycle of we raised a couple $1 billion of capital. We were building, RCN was building, many people would probably be familiar with FiOS, where they fiber to the home and triple play services. We were building that even before FiOS, long, long ago. And we raised billions of dollars because it's very expensive to build that last mile of fiber to the home for the advanced services of today, like video conferencing and streaming. All these things of today were, of course, not existent back then. Most people were on dial-up. Broadband was just coming, but the networks weren't there. The cable and phone companies hadn't really upgraded. We raised a bunch of money and we were building the networks that the world needed, or in the US that we needed in the major NFL cities. And so the interesting thing for my career is that I spent 7 years at RCN and not 1 minute in a finance function. I did, and it was intentional. I wanted to do all the things not finance, because if I wanted to do finance, in my mind, I would have just stayed in finance. And so I was looking to get operations experience, marketing, sales, and as I kind of alluded to, is somewhat self-directed and a little bit happenstance. But I ended up, running an outbound call center. I ended up kind of in New York City with the operations team, installing telephony services and helping to manage that market. I did some planning for Miami and other markets we were going to build out that we didn't get to when the financial markets changed. The dot-com kind of bubble ended and capital dried up. And I also had an opportunity, which was a great experience as well, to run a dial-up business. We had acquired several dial-up companies as part of bringing together the phone. We had the company RCN was a kind of a platform that was a public company, and they were a telco and a cable company. But our game plan was to raise money, build these networks, and offer triple play services. And we didn't have internet talent. So the company had bought a bunch of dial-up companies, because that was what the internet was back then. And we had these assets in the business that nobody was really running because it was a little bit non-core, but it was a $60 million business. It was a pretty sizable business. And so I kind of had, for a period of time, ran that, optimized, kind of revenue and cost structure. And, I was kind of the player on the field. It was really kind of interesting and exciting and a great opportunity for somebody who was fairly young as I was. So I think that was my second kind of formative kind of period of time.
Can I ask you a question there? So from the time you arrived at RCN to the time you left, again, 7-year investment there, it's a very different company when you do leave. Am I right about that? It had to be a different size, had to been so many transactions behind you,
Yeah, you're right. And I would, if I were to kind of redo my kind of life experience and career, I'd probably try to put a clock on my time at companies of 5 years, just because I think that but it's very circumstance specific. I mean, some companies you find the right one. And, I was just seeing a LinkedIn from one of my classmates in business school from college, who spent 26, 29 years at the same company and has been so it depends. But for me, there's a learning curve that sort of diminishes as you spend a lot of time in a place, but there's also the circumstance of the company. And more honestly, for me, I love the growth phase. It's so much fun. You don't know what the future is going to hold. You're making all these decisions. You're putting in place all this stuff. It's very dynamic, and the contraction or slowdown phase, it usually is just not as much fun. And honestly, that's what happened with RCN, is because of the capital, like you said, the capital, we went from, I would say, about 500 employees when I joined to over 2,000 employees, and then back to like 500 when I decided to kind of hop to the next thing. And because we had to scale back all our construction efforts, optimize and we ended up going through bankruptcy in that particular company. So it was lots of experiences, but I don't need to repeat that part of it again.
Yeah. Can I I'm curious as to, did you interact with the CFO while you were there, or was he sort of this distant figure who you'd observe and listen in on the earnings calls, perhaps,
I did interact with him a little bit more from whatever operations role I was in, and him kind of, he was not FP&A, but kind of understanding the business, the planning process. I'd end up being in front of him as part of, whatever. When I was in New York City working with the GM on our operations plan, we went to corporate and presented it to him. So I had some interaction with him, but it was not a day-to-day thing. Much more of my experience was in kind of operations and technical and more the business.
Is the thought crossing your mind that, well, maybe someday that role, or are you thinking, wow, I would want that job?
Oh, back then?
Yeah.
No, back then I like I said, I didn't have a plan to become CFO. It wasn't even my.
I want to discover where exactly the seed began to, take root.
Yeah. So, well, it's, I guess, further on, but my,
Yeah.
I guess it started to form at Vonage, which was my next company. So I made the move and it was luck, and my career there's been just kind of luck and just timing and circumstances. And so it's sometimes proactive, but sometimes just fortuitous. This case was kind of fortuitous. I mean, timing and luck sort of have to line up often for a job move. But what happened for me was the CFO of Vonage was somebody who had worked at RCN, who knew me from there. And at the time he knew me there, I was heading up our corporate development function at RCN. So he thought of me as corp dev, but I had done a whole bunch of different things. It was just that moment in time when our paths crossed. That's what he knew me as. But I met him at a charity function in 2005 where our kids went to the same grammar school, and it was like a fundraiser. And we're having a beer, and he's like, you should come join Vonage. We're expanding into Europe, and I need a corp dev team and a new market. You'd be perfect. And this is where RCN, the growth had slowed. It was getting kind of stagnant. There was leadership changes. And I was like, you know what? I'm ready for a new challenge. And this company was rocking it. They were like growing. They weren't building these expensive, costly networks. They were spending all their money on TV commercials to sell, broadband or VoIP services to people who use other people's networks. So it was kind of the SaaS, my first exposure to software and SaaS. And so I was like, that's a good model. That's a business with energy and growth. It would be so much more fun. So I made the move, and then in some ways my Vonage experience had some similarities and different, but similar in that we were high growth when I joined. One of the first things we worked on, just context for kind of the next kind of years of learning, was we did a private convertible note offering. We raised $250 million when we were private because we were spending tons of money on TV, and it was a great business growing quickly, but we were consuming a lot of money because of subscriber acquisition costs. And so we raised $250 million. It's almost like a bridge loan to an IPO, if you will, because we were very close. We had already done our Series E, and we were on the verge of kind of headed there, but we just needed a little more timing and growth. And more capital to get there. So we raised this convert. And the idea with a convert, every banker, you always tell yourself as the leadership team, and the story is, oh, you can raise this, at a premium to your current equity price, and then your stock will go up and it'll convert into equity. And it's like selling shares at a premium. Why wouldn't you want to do that? And so, it sounds great. And we did it. And the circumstances, though, kind of turned into a bit of an albatross, if you will, that security that we put in place. Because what happened is, next year in 2006, we did go public. We were successful in going public, but unfortunately, our stock price kind of went down almost immediately, and a set of circumstances that some partially predictable, but some not, played out. So the cable companies came into the market with their own versions of triple plays, including the voice service. They own the network and the customer and the bundle. We're just selling phone service to their broadband. So the competition, squeezed us out a bit. And then the wireless companies started to offer unlimited nationwide calling. They started to make calling, it wasn't 10 cents a minute anymore. It was just included. And so a lot of people started saying, hey, I don't need a home phone if I'm going to have a cell phone. So the market, the dynamics of the market sort of started to weaken for us. And then the second problem was we had continued to spend aggressively. We raised $500 million, but we spent a lot of it on TV ads and continued growth because that's what we wanted. The market wanted. We wanted to be a growth company, and at the same time we got, which was just really bad luck, we got sued by Verizon, AT&T, and Sprint for some kind of arcane intellectual property stuff that I still don't understand. But we lost to Verizon, and then we settled with Sprint and AT&T. So that kind of consumed a couple $100 million of our IPO proceeds. And so we were kind of used up most of the money we raised from the IPO, had this debt, the stock went down, and unfortunately, and this is just the last straw, the debt came due in November of 2008, which was just horrible timing. And so, because there was no debt markets, we were negative EBITDA, there was absolutely no options at all. And we actually, I transitioned into a role of heading FP&A. So this is where I kind of had started to get more on the traditional finance track. So I was kind of helping run the business, and from an FP&A perspective, we had a new CEO come in to take over from the founder, and we had to refinance this debt. We had to deal with this debt, and we were hiring bankruptcy lawyers. We were prepared to file, because what happened was this debt, most of it got bought up by a hedge fund that kind of saw the opportunity, but they also saw the control position of taking on the majority of our debt. So there was no way to negotiate around them, because they had more than half of the loan. So you couldn't get any covenants, you couldn't amend anything. You had to go through them. And there was no other source of financing. And we didn't, it's not like we didn't see this coming. We were trying to refinance this for like a year, but the market just got worse and worse and worse and worse. The capital markets and all these financial institutions started failing, and it was just progressively worse. And so we had to do the worst credit agreement in my whole life. And I really hope I never have to do one like it. But like I said, we were on the verge of filing bankruptcy, and we were at the last minute able to cut a deal with them to refinance into a new loan package that they designed that was horrible. 20% interest. You couldn't pay it off without a make whole, which is extraordinarily, expensive. The covenants were super tight. They required us to go from losing money to making a lot of money very quickly, which we could do. We knew like how to do it, but it was dramatic what we had to do to stay in compliance. And we knew if you violate the covenants, this is not a friendly kind of, they're mercenaries, and they would have most likely taken the equity of the company as, in their control position. So but bankruptcy, you lose all. So your choices, there's no good choices here. So we chose that path, which was the better one. As it turned out, the story ends well, I would say, for Vonage. But for me, that next 3 years was, hey, we had to act with incredible urgency and focus and discipline around the entire business, optimizing, expenses, revenue and expenses. And we went from a minus 50 million to plus 150 million, roughly a 25 percentage point EBITDA margin improvement in 3 years, which was huge. And we looked at every part of the business, all our vendor agreements. We right-sized, headcount, customer support. We tweaked pricing up where we could. We cut back on marketing, of course. And we just but we didn't, the business continued on and grew and was successful. And eventually that cash flow, we were able to pay them off. And, there's a whole extra story of another, 10 or so years I spent at Vonage. But for me, that ability to, when you partner with the exec team and everybody's clear on what has to happen, and there's not waffling around, well, we could just do a little bit of it, or let's see how it goes. You have to act decisively, because the costs are high. So I have mixed feelings about leverage and debt, because it's certainly been painful for those two companies, but the discipline it instills has value. So I constantly, in my current role today, and as I think about my future role, we have a great balance sheet here at Jobber, and we did it the next company I went to after Vonage and Vimeo as well. But so I would love to have the discipline of debt without having the debt. So that's something I try to think about, how to balance that.
Yeah, well, that's quite an overview for us. I'm trying to figure out the type of executive you were, though. It seems like whether it was RCN or Vonage, it seems like the leadership of the company would often involve you, whether it was trying to, debt strategy, trying to come up with an understanding of how to avoid this or that pitfall. Is that right? I mean, are you sort of a troubleshooter?
Yeah.
It seems like you were always sort of being loaned out. Or what have you.
Yeah, I would say that the biggest problem, and somebody early in my career said to me, he was the president at RCN when I joined, and he was kind of my mentor for the rotational program I was in. And one time I was in his office, and he was kind of changing his role a bit. And I was like, well, how do you decide what to do? And he said to me, well, I just kind of try and think about what the biggest problem is for the company, and I just volunteer to go do that. And it's a good way to think what is most important to the company or to your manager or whatever it is. What is the problem that needs to be solved, and try to solve it. Now, sometimes you don't have the skills for it. I mean, I skipped past the fact that I was in high yield, debt finance, and I knew a lot about debt structures and covenants and loan agreements and, markets. And so I had a lot of applicable skills to dealing with this hedge fund firm during that process. And way more than the new CEO had, because he had come up through a marketing role in a big telecom company. And so I had the skills and the passion, and I could see we could all see the problem, but I was like, we have to do these things to get out of this box we're in. And so it's kind of just helping to form the game plan and lead it in that case. But like you were referring to at RCN, there were a lot of different problems. There was a problem in New York City operation, and they sent me in there to kind of help there. And there's a problem with this call center, so they sent me there to run it. And the person who was running it quit. So they sort of,
and you're sort of like a consultant at times too, because there's a problem over here. You arrive and you try to assess: what is the problem here? Is it the management, the people involved? Can we do this differently? So you're always sort of this troubleshooter. At least that's what I'm gathering. And it's an interesting story, Craig. It really is. And I think we come upon leaders like yourself who've played this role and again, it takes a different mindset. And you probably have this great curiosity about things as far as how the business runs. That seems to be the other theme here. I don't know much about this, but let's figure this out. Problem solving. Thank you for a great overview. We're very curious as to Jobber. Tell us about this company. We're intrigued what interested you, and we're intrigued what kind of company is it? What's its offering? I know it's SaaS-based, I believe, but still say.
Jobber is a SaaS-based business. We have a subscription software component, and then we have a payments product as well. We serve home services businesses in primarily in North America, though we have customers outside of North America. So the way I kind of think about it, or I sometimes describe it, is I live in a residential neighborhood here in New Jersey. If you think about kind of all of the pickup trucks and the vans that drive through the neighborhood to do services at people's homes, those are our perspective. That's our target market. And most of those businesses are very small businesses, 1, 2, 3, 4, under 20 kind of employee businesses. It's very much in terms of the majority of the businesses in this space, it's mostly small business, mostly kind of entrepreneurs. A lot of turnover, a lot of new businesses, and there's not a lot of software. It's one of the spaces. It's a very large kind of vertical. If you think of it as like a super vertical, it's almost a horizontal software business made up of a bunch of verticals, and the key part of it for in terms of our focus on home services, the scheduling part. You have to kind of schedule a crew, schedule the customer if you need access to their home. So we are a kind of a system of record workflow management, tool for small businesses that have no other software, no other technology. They're almost always going from, pen and paper or 0 to 1 software adoption. So there's a lot of opportunity. Our mission is to help these small businesses grow and be successful and run, better, more efficient businesses, which again allows them to grow, serve their communities better, or in some cases it gives them hours back by reducing some of the kind of the manual and not really value add kind of processes to automate that. So things like quoting, we describe it as get work, do work, get paid, kind of those categories of functionality. So it's things like quoting, quoting work for customers, getting that accepted, scheduling the job, getting the crew, the customer, the materials, whatever's involved. And it's across many industries. Like I said, it could be roofing or landscaping or arborists or HVAC, painting, whatever, all those things that happen at a house or a location. So, and then the scheduling part, and then the invoicing and the payments part of it as well. So we provide that end-to-end solution. It's for the market we serve. It's really important that it be easy to use, and of course, mobile's it's obvious mobile's critical for being, because everybody's on site, and then ease of use is critical. The larger businesses in the space, the larger companies may have more complicated, more enterprise-like home services businesses with hundreds of techs and employees will have a different set of needs. And it's not the distinction for us is we're more 1 to 20 is our focus.
What's the penetration of that market currently? I mean, it would seem to me that many of them aren't operating yet. Technology back office.
If you think about the penetration from the perspective of an end-to-end, the full featured product that we offer, it's very low. It's probably, I would say, 5% or 10%. It's quite low in the space we're serving. Now, much larger businesses probably do have some kind of, some of this already in place. But for the other interesting thing about the home services space is about 20% of the market turns over every year. So there's a lot of startups, a lot of failures. People kind of move on to other things or join a different company. So there's a lot of kind of, it's very dynamic, which is good and bad. It's true SMB is where we play. But the good part is, I use the analogy. It's like we're we're the minor league. We're serving all the farm system. We're finding all the, the early players that are just kind of like, we're trying to, we don't know, not all, some of them will go on to the major leagues and be really big, successful companies. Some of them will, kind of stay and operate as smaller businesses for many, many years. And, some will go out of business and be replaced by new ones.
So could you just give us an abbreviated history then of Jobber's capital structure?
Yeah, sure. So we were, as I said, we were founded in 2011 by Sam Pillar and Alphara Seisler in Alberta, Canada, and we've raised to date about 175 million of capital. There was a series of rounds. Our most recent one was we did a Series D financing about a year ago. That was led by General Atlantic. In 2021, we had Summit came in and led our Series C. And then prior to that, we have investors like Omers and Version 1. And so we have a lot of very good venture capital investors. And that's kind of how we got to here.
Or you, and again, with your mind coming from some of what you shared, those experiences, stepping into this environment and understanding capital structures, are you? Is this just a matter of, okay, we might have to raise some additional, or are you looking at the world a little differently?
Yeah, and when I was first meeting Sam and the leadership team, we did have some of these conversations. I do, and you could, as I kind of referred to some of those prior companies, I do like a heavy equity balance sheet. Although I do also realize, coming from a company in 2021 that did have that it allows you to sometimes spend more than you should because you lose a little discipline. So that's the part I try to balance. I don't think debt is appropriate. I've done a lot of different debt, bank debt and high yield and convertible and all kinds of stuff. I don't think it's appropriate for our company where we are today. There may be a time in the future if there was, M&A or at a much later stage of growth and stability where, debt is more suitable. I think that I'm not a financial engineer trying to kind of create leverage and to create value that way. I think we need to build a great business and make, the right decisions and execute along the way. And we'll do just fine. We don't need to, do a stock buyback or, leveraged or anything like that.
We want to ask you about your lines of sight. And whenever a finance leader steps into a new organization, we're always curious if there's a particular metric that a finance leader might have added to the mix, something that wasn't being looked at regularly, or maybe they just changed the mix. Anything you've added or something you thought the company needs to be looking at more closely?
No, I wouldn't say that because I was quite impressed actually when I was getting to know the company before joining with the board package and the materials and the metrics they had and the quality and the level of kind of how thorough it was. I was always struggling to pull that together at Vonage and at Vimeo when I was in FP&A role and kind of pulling that all together into a synthesized view for the leadership and then the board. And so I was impressed that Jobber, being a bit of a smaller company, was pretty advanced in that way. So I don't think it was new metrics. So I did change some of the calculations. I did look at some and go, hey, I think this would be a more accurate way to calculate this. But we do look at all the same MRR and the customer activity and new MRR and lost MRR and LTV to CAC and efficiencies and kind of how. Growth and profitability is always a challenge. You want to grow as quickly as possible, but at least I feel like the CFO is the one responsible for ensuring that there's a return and that it's a good business and that you're not, you're efficiently deploying capital. But I can't, I also want to grow. I understand, that's what we want. That's where the market opportunity is, and we have investors and an opportunity ahead of us, and we have to be bold. But you have to kind of play both. You have to be both the gas and the brake at the same time, or you've got to figure out how to balance that.
When we think of the sector, so home services, visibility into the offering and whether people are using it the way it should be used could well determine whether it fails quickly or not. And that's true of so many software applications, but particularly I would think in this sector where if they don't have a champion in the office who's going to help bring forth the discipline required to adopt the software and understand how it brings value, the rate of failure has got to be awful high. And how do you avoid that? By understanding how successful businesses have adopted it and what were the telltale signs that the software was being adopted correctly. Am I right about that? Or how do you look at it? I believe that's.
No, that's very, very insightful, Jack. You're totally right. Most of
Yeah.
our churn happens in the first 6 months from new customers and kind of failure to adopt, failure to launch. It's exactly what you described. Because we're not replacing a different software package. We're asking people to adopt software. They have to kind of learn it and use it and change their business practices. And if they have employees, the employees have to as well, because they get all the information. It's a system of record. So all of the customer information, job history, payments, it's all has to be there and updated and maintained. And so that is the hardest part, the biggest opportunity, the most important thing for us to do well as a company is to show customers that value and to help them along the path and to make it as friction as free and as painless as possible. And I think you were also kind of alluding to the fact there are different industries. So there's different kinds of business, different sizes and different industries, and they have different needs. And they all, because they're not using software, they've all kind of have their own way of doing things in their particular business. And so it's the key for us is making it easy. So simple, easy to use, not overcomplicating our tool with lots of complexity and functionality for kind of the 1% cases, because that then burdens it and makes it harder for everybody. So it's kind of, we describe it as 80 for 80. So we're kind of 80% of the functionality for 80% of the market. So we want to do a really good job for most common use cases across, kind of those workflows, but we don't want to make it too complicated and hard and to adopt and to use and to see the value from. So that's the trade-off we constantly
So
balance.
related to this specific area of customer experience,
can you share with us, a metric that you found to be revealing in some way that maybe you didn't initially expect? Whether there was a metric that you discovered and realized people need to understand better throughout job, or why it's important. I don't know. A metric.
There's a couple that are a little bit unique to Jobber. As you said, I have worked at other SaaS companies and looked at similar kinds of at a higher level of metrics. But you're right, the customer usage, customer value, customer engagement, those are super important. Like if you're measuring the right things and those are growing and improving, usually you're gonna do well. And so I think for us, a couple for us that are a little bit Jobber specific, or at least in my experience, is the what we call engagement, where QGI, quote job invoice, kind of how frequently are people using the tool? How frequently are they going in and booking jobs? How frequently are they going in and scheduling a person or a customer or whatever? And invoicing, of course, is the ultimate goal here for them to get paid. And so so that's one, is kind of looking at the usage of the product, because otherwise they're not getting value. That's pretty clear direction to value. And the other one that's been interesting, and maybe I didn't expect this to be looking at it as closely going back a year and a half when I was joining Jobber, but there's been talk of kind of economic slowdown, and there's been definitely a little bit of kind of softening if you listen to Home Depot and Lowe's and kind of a lot of the reporting. And just we know like inflation has started to come down, the economy started to slow, and so we have a huge sample size of invoice and transactional data across all the industries and the thousands and many. We serve over 200,000 service providers, which is not as many customers because there are multiple employees per account, but we have tens of that. We have huge amounts of data available to us to look at. And what has been interesting in my role is to look at the different industries and what the average order size. Some industries saw more inflation in 2022 and less, more of a slowdown, or job volumes came down. And you would expect, I'm sure, certain things that are more discretionary, and there's been a kind of a shift. So it's just sometimes you have to kind of step back and just look at the high level and run the business. So I sometimes I don't want to go too far into we can't run a business for one particular industry or one particular data point, but it's still very helpful to see what's going on and just to understand the dynamic of how our customers are doing, because that's ultimately what matters for
Is
us
Jobber
for the business.
leveraging AI today? And maybe you didn't think it was AI 2 years ago, but now you realize no, this is actually part of the AI family. Anything you're leveraging in the AI world that you're seeing something promising come about from?
Yeah, we'll do a little bit within my finance function, but I would be honest to say we're probably taking a little bit more of a wait and see, and we'll see how we can kind of automate some of the functions that are repetitive tasks within finance. Things like maybe AP forecasting. I think there's some areas where we can get some efficiency there, but that's not going to most likely be the real needle mover for Jobber. Where I see the big opportunity, where I think we collectively see the big opportunity, is the larger teams that are resource constrained, where there's never enough people in a high growth company to do all the work that you could or you want to do. And the two that I would point to are R&D, product development, and kind of support, or kind of customer success, which includes the support function and that onboarding function, which is helping people get engaged with the product and see the value and adopt. And so I think that AI will help us to create capacity in those teams, so that we can do more of the higher value work, so that we can focus more on driving value for the business. So I think that those are two areas where we'll get some real value. And I think the third one, as I mentioned, we have a payments business, and the way we operate is we basically have the risk. If a customer processes a credit card payment through us and then there's a chargeback, if they leave us, if they don't cover that, if they just kind of take off and don't do more work to help us offset it or give the money back, then what happens is a Jobber is on the hook for that. And so credit scoring and looking for patterns, and there's fraud in there. There's fraud. You're always fighting fraud as well in this world. And so to the extent AI, which there's already elements, it's not a new thing, but to the extent, AI, pattern detection, and just helping us to reduce losses will make us, it's just better for the business. So that's, I think, going to be an area of real opportunity for us using AI.
Okay, nice. Thank you for that. We're going to move to our finance strategic moment question, where we'll ask you just for one moment of strategic insight that you've had along the way. Again, you've probably had a few of these already today, but what comes to mind when we ask for a finance strategic moment?
Yeah, it's a good question. I mean, I've had a lot of different experiences, and I feel like the one I'm going to mention here is not hugely aha, but at the time it happened, I had no awareness that this was any kind of strategic moment. But when I think back on it, the lesson was really, impactful. And I think back to 1997 when I was talking to a partner at this firm, InvestCorp, and he was the partner responsible for Saks. It's been the biggest deal we had ever bought, and was kind of a company that we really try to make sure would be successful. And he was telling me about a report that they had engaged BCG, Boston Consulting Group, this consulting firm, to kind of do an analysis of the business and kind of help us figure out how to make Saks more profitable, so we could ultimately take it public and exit the investment. And there was a bunch of analysis in there, and he said this, and I didn't, I can't say if this is true or not, but he said to me that BCG pioneered this concept of the 80-20 rule, which he proceeded to explain to me and then show me this material in this presentation. And the idea is that in every business, roughly plus or minus, there are 20% of your customers where you make 80% of your profits. It's a bell curve idea, and you really, the point is, you've got to find that and figure out how to action that, because that's how you're going to move the needle in a business. That's going to be way more impactful than spreading your resources across like a lot of smaller groups. And in the case of Saks, what they determined was, and I think it was more like 5% or maybe even fewer of our customers generated 50% of our revenue. And they were the ones that were very into, Saks is a high-end luxury chain, that clothing, cosmetics, jewelry, perfume, various things. And what they determined was there was a group of wealthy customers who shopped very frequently and really cared about fashion. And they were the ones that you didn't want to lose them to Neiman Marcus or other competitors. You wanted to make sure you served their needs, because they were the ones really paying the bills. And as a result of that analysis, just in the case of Saks, strategy that came from that is we did surveys of them once we realized all this and figured out what they wanted. And it was determined that they really cared about shoe selection, high-end, luxury brands, designer brands. They really valued personal shopping, special hours where they were the only ones allowed in the store. And so we basically created a loyalty program and a product portfolio catered towards them, which really helped Saks to become, even more successful, and did it ultimately go public and all of that. And the lesson, and I've just, as I said, I didn't maybe realize how insightful that was at the time. But when I look at all of the different M&A transactions I've done along the way, looking at businesses or my own business plans for the annual plan every year, or maybe it's a investment plan within a company. We want to do this project and it's going to cost us money and here's the return. I always kind of approach it from what are the 1 or 2 or 3 most important assumptions that are make or break. If you get those right, you're probably most of the way home. And if you miss those, there's no other path back. And so just kind of identify that. And there's really two important things there. One is identifying them and asking, are those assumptions realistic? Because if they're bad assumptions, then you're not going to be able to achieve them. And even if they are right and achievable, you still have to achieve them. And so you still have to make sure you stay very focused. You don't spread your resources. You don't get distracted. The whole company or whoever's involved in execution understands where the value is, what we have to do, and that we stay laser focused on achieving that. So it's that kind of iteration, or maybe twisted 80-20 rule a little bit, but that idea has kind of shown up in most of my work since.
CFOs and controllers, does expense management feel like a necessary evil? It's time to switch to Brex. Brex automates and accelerates spend management with easy-to-use corporate cards, travel, expense management, and bill pay, all on one AI-powered platform. Brex makes it easy to boost efficiency and compliance enterprise-wide and free up your managers, employees, and accounting team for higher impact work. Top companies from startups to enterprises are using Brex to automate manual work and transform their finance operations. We're talking DoorDash, Robinhood, Airtable, and countless other industry leaders. Ready to join them? Switch to AI-powered spend management at Brex.com.
We're going to jump to our mentoring round, where we'll ask you several quick questions intended to inform and inspire our future finance leaders. We're going to want you to look back again. And actually, September 2022, when you first arrived there, during that first 60 days, there must have been something. You had observed CFOs for the last few decades, but there must have been something that surprised you about the role, or, made you think, oh, I wish I knew about this. Anything come to mind? Something, and we're going to invite you to go back to that September of 2022 and just share this piece of advice with yourself in case. But anything come to mind? What is it that you wish you knew when you first arrived?
Well, I wish I had maybe been a better networker along the way up till then. And I think networking is twofold. In a new company, it's internal, like just getting to know people and all the key players at all the levels and who's got the information and who's doing what, like just so you can get context and you build relationships, because it's what's new for me in a CFO role is I'm more now kind of the one helping to set the strategy and kind of calling the plays. And I need other people to understand that and support that and help me make the right decisions and then help execute. And so there's a personal aspect of getting that information and trust and alignment that I probably didn't invest as much in before, other than in task roles where I'm building a model or a plan, or I need to go talk to somebody to get this thing. But it's the relationship side of it that is more valuable now in this role that I still need to, make more of an effort of investment there. And then, in it, I've sort of concluded that I love the growth companies in the growth phase. And I do like private companies. I've worked mostly at public companies. This one's now private. I do like the private setting. And I think if I could go further back, I would have kind of advised myself to try to find a way to network better with venture capitalists and CEOs and CFOs of these kinds of companies. Because I realize now there's a whole network of information and people talking to each other that I was just not really plugged into. And I feel very blessed and lucky that I landed on Jobber, but it wasn't through my orchestrated efforts. And so I maybe could have relied a little less on luck and maybe a little bit more of, kind of thinking of what that formula is for finding those opportunities and then for being successful in them. When I think about my individual experience here at Jobber, it was definitely a whirlwind when I joined. And and if I could maybe, I wouldn't probably have planned it out this way if I could choose, because what happened was I joined in September of 2022, and I had to 2 weeks later present the annual plan to the board because our fiscal year at that time was ending September 30th. So October 1st was our new fiscal year. So I'm presenting a plan that I barely understand the business and the metrics and how the plan was built and what's in there. And, I'm selling it like I fully believe it and understand it. So I had to do a crash course with the help of the leadership team and my team and as many people as I could talk to, but you only do as much as you can in that amount of time. And then right after that, we were doing the Series D fundraise, so I'm now out raising capital for a company that I just joined, and the founder and the founders took most of the lead on that and could tell the story way better than me. But that was an accelerated learning curve for me. And that was not a good market, as you probably recall, late 2022, out trying to raise capital. And it turned out to be an extremely successful round for us. We brought in GA as an amazing investor. We have a tremendous balance sheet. It was a completely clean, term sheet round and a valuation well above the previous round. And so everything turned out really well. But if I could have done it maybe at a little bit slower pace, I probably would have chosen that.
We always like to ask our guests to reflect a little on the personal side. Is there something most people generally don't know about you?
Yeah, maybe. I'm sure there's a lot of things, but one thing I'd say one thing I do is I run every single morning, and I've been doing it for about 10 years now. Every morning I run 3 miles. Like the first thing I do, I put the coffee on and I run every day, no matter where I am, no matter what the weather.
What time of morning is it?
7-ish. It's not super. When I was commuting to other places, I remote now, but when I was commuting to New York with Vimeo or to Vonage, it would be maybe more like 6. And so, get up, get out, run. And that's tough to do in the cold weather. It's rainy or, what I found for me personally is I had to do that to remove the debate in my head of, should I do this? When am I going to do this? Do I want to do this? I would agonize every day about this decision. And for a while, I tried to do it Monday to Friday and take the weekends off. But then I realized on Monday, I didn't want to do it anymore. It was like I went on vacation and came back. And so I decided for myself, there's just no decision. It's just something I will do every single day, no matter what. And so it's been, I love it though, because, and I'm not one of those people that talks about runner's high and loves running. I love being done with the run. I love coming back to my coffee, having checked the box. I accomplished something for the day. I was totally in control of that. The rest of the day, I may not be able to control, but that's something I can control. And it's, it's good for you.
Would we assume you run on vacations then
everywhere
as well?
Yeah. We were just on a cruise ship. I ran, around the decks of the cruise ship. I run in treadmills when I visit, the leadership team up in Toronto or Edmonton. I'll wherever I am, I run.
Would you have a book selection for us? Doesn't have to be a business book. Maybe it's just something you enjoy.
Yeah, I don't read a ton of business books. I am in the middle of one though. So actually, what I like to do when I read is I like to read about music. I love to go to live music, and so I'm very curious about other people's lives, particularly the ones that are completely different from the one I lived and that I'll ever live at this point. So I gravitate towards, musicians and artists and pop culture, and either times before I was alive, like the 60s or 70s, before things that I won't be able to experience or things that I won't because of the path I've chosen and just the person I am. So I am always interested about these other types of, kind of environments or just personal people's experiences. And the one I'm reading right now that I could probably position this as a business book, although it would be a stretch, but it's called Madonna, A Rebel Life. It's a biography about Madonna. And it's the reason I say you could think about it as a business book is when I read it and I hear her story, I do think of like a startup and building a business where she grew up in Detroit and she had a vision and a dream to be a star. She started out in dancing. She dropped out of, Mark Zuckerberg dropped out of, Harvard and started Facebook. She dropped out of Michigan, a very good school with a scholarship to move to New York and become a dancer with no money and no support from her family and living in Alphabet City. And the whole story is from the lowest of low. But she was very determined, very focused, flexible. She had, I could jokingly say, she had some product market fit because she was a dancer and then she became a singer. And so she was a performer right at the time when MTV was coming out with music videos. And then she really rode she didn't get lucky. She created amazing videos and music, and she was a great performer, but she found the opportunity, and then she was extremely curious about the business and about production and about all the aspects of it. So she was always improving and learning, and with determination of where she was going, but also flexibility. She went down some paths that didn't work, and she reset, and she responded to circumstances and didn't give up, and kind of looked for the opportunity and found it, and obviously made it big.
Interesting. Great selection. We're up to our final question. We would like you to look forward for us the next 12 months and share your CFO priorities with us. What would those be?
Yeah, it's always planning for growth, making sure that I'm kind of looking into the future as we get bigger and as the scope of our business. And Jobber is I love how simple our business is. It's really uncomplicated relative to kind of Vonage and Vimeo and the other companies I came from that had, enterprise and consumer and self-serve and geographies and products and M&A and just a lot more. We just very, in a relative sense, a very simple business. I'm sure if, the people that have been a Jobber for 10 years would say the Jobber of today is way more complicated than the Jobber of 10 years ago. But from where I come from, Jobber is a pretty simple business. But it will get more complicated. That's just natural as we get bigger, as we roll out new products and initiatives, and we may go international, or maybe we'll do M&A. We'll do these things. So I want to make sure that I think ahead from a systems and a process and kind of a people and skills to what the future looks like. And I'm very much about avoiding the drama and the fire drills to the extent you can. So kind of thinking ahead and doing the things you can in a more measured way than kind of waiting for to be forced into doing things. So that's one. Kind of developing my team, helping them be successful, helping them see value and connection with the company and what's going on and all the change, and just helping them to stay engaged and successful is really important for me. And at this point, so I'd say those are the things that I would like to do. Of course, it's an ongoing thing, growth versus profitability, and making sure that we're running a good business and that we're delivering good results and making the right investments for the future. And when things don't work out, you have to reset like Madonna and move in a different direction. You have to be real about it, but at the same time, take chances. We have to be bold, take chances. We can, we need to, we should. It's our vision to be the biggest in the home services space. And, we're kind of there today, but it's so early on that the real goal is, years out.
Craig Wert, thank you for joining us on CFO Thought Leader.
Thank you, Jack.
Hello, Thought Leader listeners. We hope 2024 is treating you well. If you haven't already, we hope you'll pay a visit to CFOThoughtLeader.com and go ahead and subscribe to our Mentoring Round newsletter, where we highlight the career lessons and moments of strategic insight shared by our recent CFO guests. Also, LinkedIn users, please go ahead and follow our CFO Thought Leader company page, and you'll be certain not to miss a single Thought Leader video debut. CFO Thought Leader, the #1 thought leadership platform exclusively for and by CFOs. As always, thank you for listening.